Welcome. If you're just getting started with options, you're probably trying to wrap your head around buying calls and puts.
Yeah, that's usually the first step.
But, really understanding the other side, selling options, and, well, the fundamental differences between buying and selling, that's key. It's what unlocks the real potential, we think.
Absolutely. Here at AdvancedAutoTrades.com, we really see that as the foundation for building solid option strategies. It can seem complex at first, the rights, the responsibilities.
Right. So today, our goal is pretty straightforward.
Yeah.
Let's just break down the core difference. What does it mean to be an option buyer versus an option seller?
Exactly. And remember, it all boils down to just two types of contracts, calls and puts. Everything else flows from buying or selling one of those two.
And while, beginners often look at buying first, selling options is a really powerful way to potentially generate income. It's a core strategy for a lot of experienced folks.
That's a great point. The essential difference, the real heart of it, is who has the right and who takes on the obligation.
Okay, rights and obligations. Let's use that framework.
Think of it like this. In every single options trade, one person is paying for a specific privilege, right? And the other person is getting paid to accept a potential responsibility down the line.
All right, let's dig into the specifics then. Say I buy a call option, I'm paying a premium, putting money out. What am I actually getting for that cash?
Okay, so you pay that premium, and in return, you get the right. Importantly, it's not an obligation, just the right to buy the underlying stock at a set price that's the strike price.
And I can do that anytime before it expires.
Exactly, anytime before expiration. So imagine a stock is at $50. You buy a call with a $50 strike. You now have the choice to buy that stock for $50, no matter where the actual market price goes, until that option expires.
Yeah, my hope is the stock price goes up.
Way up, ideally, above that $50 strike price, plus the premium you paid for you to make a profit.
Got it. Okay, what if I buy a put option instead? Same idea with paying a premium.
Yep, you still pay a premium upfront. It's a cost to you. But this time, you're buying the right to sell the underlying stock at the strike price, again, before it expires.
The same $50 stock example. I buy a $50 strike put. Now I have the right to sell it at $50.
That's right. You have the choice to sell it for $50, even if the market price drops to, say, $40. So as a put buyer, you're hoping the stock price falls below that strike price.
So the big takeaway for buyers seems to be you pay for a choice, for flexibility.
Yeah.
You can act, but you don't have to if it doesn't make sense.
Precisely. You control the decision to exercise. Now, let's flip it. Let's look at the option sellers.
Right. What happens when I sell a call option? I'm on the other side now.
Okay, when you sell a call, you receive the premium. Money comes into your account immediately. That's the incentive.
But there's a catch, right?
There is. You take on the obligation. You are now obliged to sell the underlying stock at that strike price if the buyer decides to exercise their right.
And they usually do that near expiration.
Mostly, yes, or if they get assigned. Though technically, American-style options can be exercised early, which can sometimes surprise sellers. So as the call seller, your ideal outcome is that the stock price falls or maybe just stays flat below the strike price.
So the buyer doesn't want to exercise.
Exactly. The right isn't valuable if the market price is below the strike.
Okay. And selling a put option, I assume I also get paid up front.
You do. You collect that premium. But now your obligation is to buy the underlying stock at the strike price if the put buyer exercises their right to sell it to you.
So, again, usually near expiration or assignment.
Correct. And as the put seller, you're hoping the stock price goes up, or at least stays above the strike price. That way, the buyer won't want to sell it to you for less than the market price.
Because they could sell it for more on the open market.
Right. And because sellers take on this obligation, this potential responsibility, brokers usually require you to have funds set aside. That's where margin often comes in, as a sort of security deposit.
Okay, so sellers get paid, but they're on the hook if the buyer acts. You mentioned earlier closing out a short position. You don't have to wait until expiration.
Good point. No, you don't. If you sold an option to open a position, you can get out of that obligation by simply buying back the exact same option contract. That's called buying to close. It cancels out your original sale.
All right, let's connect this to what we think the stock price might do, the strategy behind it.
Yeah, the directional bet, essentially. It's pretty clear for buyers. Buy a call. You're bullish. You think the price is going up.
Buy a put.
You're bearish. You expect the price to fall.
Makes sense. What about the sellers? Is it just the opposite?
Kinda, but with a twist. If you sell a call, you're generally neutral to bearish. You win if the price goes down, stays flat, or even goes up slightly, as long as it stays below your strike price at expiration.
Wow.
And if you sell a put, you're neutral to bullish. You want the price to go up, stay flat, or even dip a little, just as long as it stays above your strike price.
So selling options, you can potentially profit even if the stock doesn't really move much. It just has to not move against you too badly.
Exactly. It's a key insight. Experienced sellers often capitalize on time decay, the fact that options lose value as they approach expiration. They can profit from that decay even if the stock price just treads water. Buyers, on the other hand, often need significant price movement or volatility to really pay off.
That sideways profit potential is really interesting for beginners to grasp. So, okay, scenario. I have a really strong feeling a stock is going to tank, fall sharply. Which side makes more sense, buying or selling?
Well, if you have a strong conviction about a sharp downward move, buying a put option is usually the most direct way to play that.
Because my profit potential aligns directly with the falling price.
Right. The further it falls below your strike, the more valuable your put option becomes. Selling a call could work if it falls, but your profit is capped at the premium you received initially, and you still have risk if you're wrong and the price shoots up instead. Buying the put is the cleaner bearish bet in that case.
Got it. Okay, let's get into the nuts and bolts. Placing the actual trades. Those terms like buy to open, sell to close. Debits, credits.
Right, the plumbing of it all. So when you start a position by buying an option, that's a buy to open order, or BTO.
And money leaves my account.
Yes, it results in a debit. You pay the premium. Later, when you want to get out of that long position, you sell to close, or STC.
And hopefully I get more money back than I paid.
That's the goal. You receive a credit when you sell to close. If that credit is bigger than your initial debit, you've made a profit.
Clear. Now for the sellers. How do they start?
They start by selling to open, or STO. This is how you initiate a short options position.
And they get paid.
Correct. It results in a credit to their account the premium received. Now, to get out of that short position, they need to do the opposite of what they did initially.
Which is buying it back.
Exactly. They use a buy to close order, or BTC. This requires paying money out, so it's a debit. Their profit comes if this debit is less than the initial credit they received.
Can we do a super quick numbers example? Just to see it?
Sure. Well, let's say you BTO buy to open a call for $2. That's a $200 debit, right? Because options contracts usually control 100 shares.
Okay, $200 out.
Then the stock moves favorably. You FTC sell to close that same call for $5. That's a $500 credit.
So $500 minus $200 out. $300 profit.
Exactly. Now, selling side. You STO sell to open a put, and you collect a $4 premium. That's a $400 credit up front.
$400 in the account.
The stock behaves, time passes. You decide to BTC buy to close that put for just $1. That's a $100 debit.
So $400 credit initially minus the $100 debit to close, $300 profit again.
You got it. That's the basic flow of debits and credits for opening and closing.
Seeing the money move like that helps a lot. Okay, another really crucial piece, especially for beginners, cash versus margin accounts. I remember being totally confused by this at first. Why does this matter so much for options?
Yeah, it's fundamental. Basically, a cash account means you need the full amount of capital required for the trade's potential risk sitting there in cash.
No borrowing involved.
Yeah. Right. Margin, on the other hand, means your broker might lend you funds, or, more commonly with options, allow you to put up less capital than the theoretical maximum risk of the trade.
So walk me through a cash account first. What can I typically do?
Cash accounts are usually required if you're just buying options outright, what we call net long positions. So buying calls, buying puts.
Makes sense. You need the cash to pay the premium.
Exactly. If an option costs $50 to buy, you need $50 cash. They're also often mandatory in retirement accounts like IRAs because rules often restrict borrowing or leverage in those. If you do more complex trades like spreads in a cash account, you need enough cash to cover the maximum possible loss on that specific spread. The broker checks before letting the trade go through.
Okay. And margin accounts, how do they differ?
Margin accounts are much more common when you're selling options, taking on net short positions, because you have that potential obligation we talked about.
The obligation to buy or sell the stock later.
Right. The broker wants to know you can make good on it. So they require margin. But here's the key difference. They might not require you to have the entire potential loss amount in your account. They calculate an initial margin requirement, which is usually a percentage of the max risk.
So, like, if selling a put has a theoretical max risk of $1,000 if the stock goes to zero, I might not need the full $1,000 in my account.
Correct. Maybe you collected $100 in premium, The broker might calculate your margin requirement is, say, only $200 or $300 based on the stock price, volatility, etc. So you only need that much set aside initially.
That sounds potentially easier to get started with selling then. Frees up capital.
It can seem that way, but, and this is incredibly important, margin does not limit your potential loss. You can absolutely still lose the full maximum risk of that trade, sometimes even more if things go really wrong. The margin is just the deposit the broker requires upfront.
So it's not a safety net for my losses, it's more for the broker's protection.
Pretty much. And margin rules vary a lot between brokers. So if you're starting out, you absolutely must understand your specific broker's margin policies, how they calculate it, and the real risks involved.
Any other margin concepts to be aware of?
Well, for more advanced accounts, there's something called exactly. Buying generally offers defined risk. You can only lose the premium you paid, but needs a decent price move to be profitable. Selling often has limited profit potential capped at the premium, but can win even with sideways movement, though the potential risk can be much larger if you're wrong.
So for anyone listening who's just starting their options journey,
Yeah.
really spending time understanding these roles, buyer versus seller, it's probably the most important first step you can take.
Couldn't agree more. It shapes your whole approach, what strategies make sense for you, your risk tolerance, and your view of the market.
Definitely. Okay, so here's something to think about as we close out. Now that you have a clearer picture of the buyer's rights and the seller's obligations, what kinds of market conditions, like high volatility, low volatility, trending sideways, might naturally favor buying options versus selling them? Mull that over.
Good question to ponder.
And of course, for more learning, strategy breakdowns, and tools, you can always visit us over at advancedautotrades.com. Thanks for tuning in today. If you enjoyed this episode and want to stay ahead with fresh insights every other day, don't forget to hit that subscribe button or follow our podcast. We've got more exciting content coming your way, and we can't wait to have you back. See you soon.